All right, we have more changes unfolding in the U.S. economy and over in the swamp of Washington, D.C. Changes that have a lot happening this week. Market moving events, interest rate moving events. For instance, the CPI prints released tomorrow. The next FOMC meeting also begins tomorrow as well, which brings us to the elephant in the room. What's going to happen at that meeting? What will they say behind closed doors? Well, some new numbers came to my attention this weekend. Numbers that may shed some light on why the Fed could be forced to cut rates sooner than we had thought. They're so big, these numbers, they'll probably make your head explode. So we're going to look at what's happening with the Fed and what's happening over on Capitol Hill, the implications, for instance, of this new spending bill that they're trying to get pushed through. But we'll also look at why higher for longer may not be an option anymore. As it turns out, corporations and commercial real estate aren't the only sectors with a wall of maturing debt coming due next year. Our government has its own wall of debt maturities, $8.5 trillion worth, in fact, a number that they simply cannot afford. But before we get started, press the like button and consider subscribing. It helps the channel out, and I appreciate your support. So Congress, folks, the U.S. House of Representatives, the political body responsible for government spending, responsible for our nation's fiscal discipline, well, right now, they're negotiating a funding bill to keep the government open, all right? They've been negotiating this for weeks. The Senate Majority Leader, Chuck Schumer, and the House Speaker, Mike Johnson, have thus far come up short, not able to make a deal. Now remember, Mike Johnson, he's the new Speaker of the House, a Republican. He promised when he was running for Speaker 6 weeks ago no additional Ukraine military aid, that he wouldn't approve any additional spending for the Ukraine war effort. Well, it looks like he's a big fat liar, folks. Now, don't get me wrong, I understand that the Speaker's job is to legislate, negotiate, keep the government running, to lead the House, all members in the House, but it doesn't change the fact that he lied. Should we be surprised? Obviously not. He's a politician, but realize what's on the table right now, right? A spending bill, a massive spending bill that the president, is asking to get approved for $111 billion. That combines Ukraine, Israel, and Taiwan military at $111 billion of our money gone. Poof. Given to these other countries. $61 billion of that is earmarked for Ukraine. The only thing standing in its way right now is a small cohort of congressmen referred to as the House Freedom Caucus, pissed by the way that their new speaker is folding like a cheap suit, capitulating to the president. Apparently, the only thing that Mike Johnson's asking for in order to back this bill is more border funding, which is a joke. It's something that you throw in as cover, as a talking point. So let me know in the comments what you think about this. Do you think borrowing an additional $61 billion and just giving it to Ukraine is a good idea? Well, if you do, what I'm about to show you in a minute may change your mind. Now, what happens when Congress approves new spending like this? Like they're trying to do right now. It gets signed into law, right? And handed off to Janet Yellen at Treasury to orchestrate the borrowing plan. That's right, we borrow it, all right? There's no reserves in a vault somewhere that we grab the $111 billion from. No, we have no reserves. We have no surplus. What we have is a big fat deficit, which brings us to what happens tomorrow at the next FOMC meeting. Well, we all know, what the market thinks. The market's pricing in rate cuts, all right? That the Federal Reserve will cut rates sooner than later. Currently, betting odds, for instance, of a rate cut at tomorrow's meeting are at 0%. So no chance of a cut tomorrow. They put a 4% chance, though, of a January rate cut and 40% odds that the Fed cuts by March. Now, how likely is that to happen? Well, take a listen to the chairman of the Federal Reserve, Jerome Powell himself, after last month's FOMC meeting. He was asked point blank about this, and he answered the question. Take a listen to this.
What then is the potential impact on the trajectory of rate cuts? Could we see those maybe pulled forward or have to see more than what the September SEP indicated?
So it's the fact is the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts. We're still very focused on the first question, which is have we achieved a stance of monetary policy that's sufficiently restrictive to bring inflation down to 2% over time, sustainably? That is the question we're focusing on. The next question, as you know, will be for how long will we remain restrictive? Will policy remain restrictive? And what we said there is that we'll keep policy restrictive until we're confident that inflation is on a sustainable path down to 2%.
So again, how likely is it that the market's right, that the first rate cut happens in March, in just 3 months from today? Logically, I'd say very unlikely, unless there's some massive economic pain. Loosening monetary policy now seems completely counterintuitive, right? Something that the Fed wouldn't risk doing, as inflation could just come roaring back with a vengeance. But then I was passed this report on what happens next year in 2024. What happens to a third of all outstanding U.S. government debt next year? It matures. Roughly 33% of all outstanding public debt has a maturity date of 2024. That's around $8.5 trillion. $8.5 trillion, folks. Trillion with a T. We always talk about how there's this wall of corporate and CRE loan maturities barreling down next year, how the number of loans that mature and roll over double in 2024, then again in 2025, all the way through 2028. Well, it turns out it's not just corporations and real estate investors that are facing this problem. It's also the U.S. government. So here's the thing. Something I spoke about on Twitter actually yesterday as well, how the cost to service our nation's debt right now, just the interest alone, only the interest expense crossed $1 trillion in October. And the kicker is, that's with an average interest rate of 3%. So what happens when $8.5 trillion rolls over next year in 2024? Treasury needs to reborrow that money at the current rate. Well, that's around 200 basis points higher than it is right now. In fact, when I was researching this, I came across a report published by the St. Louis Fed this summer. It turns out that they've been thinking about this for months, contemplating how to handle it. It's a public report. You can go to their website and read it yourself. It's titled Assessing the Costs of Rolling Over Government Debt. The entire report is about this specific issue. They calculate the ridiculous increase in interest expense that we're looking at should rates stay this high throughout 2024. Should the Fed not cut and cut fast? They write this: in the span of about 1 year, the Federal Open Market Committee, the FOMC, has raised the federal funds target rate from near 0 to over 5%. This has driven up other rates, mortgages, U.S. treasuries, bank loans, etc. Given the high speed at which rates have risen, there are concerns now about the cost of rolling over the existing debt for firms, households, and for our government. Specifically, when debt matures, issuers decide whether to roll over their debt by issuing new debt at the current rate or find other resources to repay the debt. Now, in the government's case, they'd issue new debt at the current rate, like we just said a minute ago. That means $8.5 trillion in new borrowing at a rate of around 5%. Now, technically, it's not the Fed's job to worry about this. The Fed has two jobs. That's it. Their mandate is to keep inflation at 2% and to maximize employment. Not worry about if we're running a surplus or a deficit. It's the reason that the Federal Reserve was established as a non-government entity. It technically falls outside of government, outside the control of the executive. The person whose job this is to worry about is our president and his cabinet, specifically Janet Yellen, the Secretary of Treasury. She's the one who has to figure out how to borrow the money, right? So will the Fed cut rates in March? I don't know. There's really no way to know for sure what they're going to do. The better question, though, is should they cut rates? And no, they should not. They should leave rates higher for longer. This policy, higher interest rates combined with tighter lending standards, is working. It's capturing the low-hanging fruit, the companies who are in no position to even be in business right now, the companies who operate relying on loans and easy money. We've seen hundreds of large public companies already go belly up. Just last week, another company you may have heard of, maybe you even use them, shut down due to this exact issue, due to their loans maturing and their credit lines drying up. Smile Direct Club, that's the name of the company, a telehealth company who sold a product similar to Invisalign to straighten your teeth without braces. They had 2 million customers. 2 million people had used their product, but they were unprofitable and only stayed in business this long due to free money, banks being willing to loan them money at 1 or 2 points. Well, that just ended for them. They had $900 billion in debt. These types of companies, large businesses with a lot of debt, operating in the gray zone where they barely break a profit, well, their loans are coming due next year. The number of companies in this position is double what it was in 2023. So no, the Fed shouldn't cut rates. but that doesn't mean that they won't. Alright, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's alright too. Either way, I appreciate you watching.